In 1956, a young man returned to Omaha and started his own partnership from his bedroom. His strategy? Buy terrible companies at unbelievably cheap prices. He called it cigar butt investing. Imagine finding a discarded cigar with one puff left. It's ugly, but it's free. That's how he viewed deeply undervalued stocks. Ugly, but with one last profit to be squeezed out. Over 13 years, his partnership averaged nearly 30% annual returns. By age 39, he was worth $25 million. But something changed. Buffett realized his first big mistakes. Buying cheap junk just wasn't enough to build real wealth. Then his partner Charlie Munger gave him a piece of advice that changed everything. It's better to buy a wonderful company at a fair price than a fair company at a wonderful price. This led Buffett to search for companies with a moat. In business, a moat protects profits from competitors, strong brands, loyal customers, and competitive advantage. Companies like Coca-Cola, American Express, and the Washington Post. He began buying large stakes in great companies and holding them for decades, creating unparalleled wealth. This is the story of a failing textile mill that became a $700 billion empire, all because of one man saw a different future. When Warren Buffett bought Berkshire Hathaway, was cheap, struggling company. But he had no intention of just running a textile business. He transformed it into a holding company, a vehicle to acquire great businesses. But then came the real stroke genius, insurance. Insurance companies collect premiums upfront and pay claims later. This creates massive pool cash called float. Buffett's brilliance was to use this float billions dollars not just to hold, but to invest and buy even more great companies. And that's when the snowball started rolling. A masterpiece of financial engineering that created one of the greatest fortunes history, from $11 per share to over $500,000. An empire built wisdom and discipline. And yet, the man built it still lives in same house bought in 1958. He drives modest car, preferring function over flash. And breakfast of choice? A simple meal from McDonald's. So what's true measure of wealth? It's not you own, who you are and impact make. It wasn't luck. It wasn't genius predictions. It was patience, discipline, emotional control, long-term thinking, buying value, not hype. Buffett never tried to predict the market. He focused on understanding businesses, and he held them. For decades. The world of investing often portrayed as a fast-paced, high-stakes game. But Warren Buffett didn't beat the market by being flashy. He did it by being consistent. He followed two simple rules. First, don't lose money. And the second rule, never forget the first rule. But maybe his most important lesson of all is this. The best investment you can make is in yourself. Invest in your knowledge. Invest in your growth. That's an investment that always pays off.